Powell day 2 meeting done. Bottom line that we got out of what happened with Powell and the Fed today, here you go. First, Morgan Stanley is yapping about how the Federal Reserve will delay its rate cuts until March of 2026, but then they will cut 7 times in 2026. So basically, if you've been betting on rate cuts, tariffs have now delayed rate cuts by 3 to 9 months. And here you go, this is where they talk about tariffs. And so, sorry if you've been betting on rate cuts, Donald Trump delayed that. And now it's all going to get backloaded to 2026, says Morgan Stanley. Now, they're predicting 7 rate cuts next year. And a lot of people on social media are saying, oh my gosh, if the Fed cuts this much, there's probably a really big underlying problem. And that could be true. But what I'd like to do first is look at what the market is already pricing in for 2026, because in my opinion, it's the delta that matters. You know, if the market is pricing in 2 rate cuts for 2026 and Morgan Stanley is predicting 7, that'd be a problem, right? But if the market's pricing in a lot of rate cuts, maybe it's not that big of a deal. So what we could do is we could look at futures markets and understand, okay, what's trading, you know, what's the futures market basically saying in terms of where the Federal Reserve Fed futures funds rate will be at the end of 2026? And the answer is actually 5 rate cuts. So markets are currently pricing in a negative 1.25% in rate cuts by the end of 2026. That would bring us to about 3.25. 3 to 3.25, whereas Morgan Stanley is predicting about 2.5 to 2.75, so that extra kind of 2-ish rate cuts in there. Markets are projecting that we will have, by the end of this year, about 2.4 rate cuts, so slightly closer to 2 than 3, but it's a little bit of a toss-up, and that's as of December 10th. Third rate cut almost fully priced in for January 28th, that's my birthday, 2026. And then you have rate cuts just sort of evenly scattered throughout 26. So this isn't very far away from what futures markets are already pricing in. So I don't necessarily think this is something that indicates, we've got really big problems coming. However, Powell did today spend more time talking about the concept of the Beverage Curve, or it's spelled Beverage, but it's technically pronounced Beverage Curve, which I think sounds really weird because it's like, are we talking about like beverages, like beer and, coffee or what? But anyway, on the eHack app, which you can get, you just throw in Meet Kevin into your Android or Apple App Store, you'll see the Meet Kevin app. And what we did is I threw in here the normal versus the abnormal charts for the Beverage Curve. And it's worth just doing a quick understanding of it because Powell does talk about this. Today, during his Senate meeting, he talked about how low vacancies and low hiring could normalize and lead to a significant jump in unemployment. We've talked about this before, so it's just worth briefly rehashing. This is the big concern that I think is driving a lot of the Fed officials to start thinking we need preemptive cuts. I know that there's this concern that there's going to be inflation coming. I mean, Powell mentions it himself. He says the majority of forecasters right now are looking at a significant increase in inflation by the end of the year. We just don't know how big that impact is going to be or when it's going to happen. The good news, though, is housing services are going to be an anchor because rents have finally stabilized and some markets are negative. House hack, for example, we saw rents going negative when we were exploring areas like in Arizona or Texas in 2022 and 2023, and it was a warning sign for us not to invest in those markets because there was an oversaturation of product. And so that's why we stayed out of those markets, and sure enough, those markets have had more problems with price than the markets we ended up investing in. Real estate's really slow moving, so you can kind of see this happening. But rents aren't moving like they were during COVID, which is really important because it means it's going to weigh down consumer price inflation over the next few years, which is actually really conducive towards rate cuts because housing makes up about 35% of the CPI inflation reading and about 25% of what the Fed uses, the PCE inflation readings. So housing's a huge component. Obviously, when we go look at the inflation reports in the coming weeks, what we want to pay attention to are goods inflation levels, which I expect to see more of in the producer price side than on the consumer side. But that said, if those forecasts are wrong and Powell's wrong that, there's this big wave of tariff inflation coming, following our June 9th expiration of the Liberation Day pause, hopefully we get some negotiated deals, then yeah, the path to cutting rates could be that we're cutting because we don't need high rates anymore because of inflation coming down or normalizing. Or it could be, like Jay Powell said yesterday, hey, growth is slowing and low vacancies and low hiring could end up normalizing, leading to a significant jump in unemployment. And this is where we get to this Beverage Curve, which very briefly, you may have seen it before, I'll just quickly explain it again. It's very, very important because where we sit right now is very abnormal. Here is a more normal Beverage Curve from 2000 to 2019, and it shows this downward sloping relationship. It's really simple. When job openings are really, really high, unemployment tends to be on the low side. So here's the unemployment rate over here. So if you get low unemployment, you go to the left. High job openings, you go to the top. You get a normal position on the curve. If you get high or sort of low job openings, you tend to see the unemployment rate in the high environment over here. So you've got high unemployment and low job openings. But this is not where we are right now. We sit in a very unusual place where job openings have collapsed on the left side of the curve. And we're actually plotting dots on this left side right here between 2023 and 24. In fact, here's a snapshot of what the Beverage Curve looks like right now. And all of these dots right here are 2023 and 24. So this abnormal curve, very abnormal, has been building since the post-pandemic distortions. And what Jay Powell is really concerned about is that when this normalizes, we are going to see, where we are at this very, very low level of vacancies. We would expect to see this curve normalize. And if the curve normalizes to, this level over here, where job vacancies are right now, very, very low, well, we could be at a 12 to 14% unemployment rate. What's interesting, though, is while job openings have been plummeting, they've really plummeted to levels that we last saw in 2019 and 2018. And this is where a lot of people say we don't necessarily have to see a big surge of unemployment. So a lot of this is just COVID distortion right here that shows, yes, the job openings rate is plummeting, but when we look at the actual nominal level of job openings, the nominal level of job openings is sort of consistent with this expansionary level we saw in 2018, 2019, although we've seen structurally higher job openings. And one of the other distortions of this could be that we have fewer people getting into trades and manufacturing now, which makes it even harder to compare to the past. But let's look at the rate of change. And to try to get rid of some of these distortions over time, let's look at the actual percent change from a year ago. And let's go with a quarterly here just to smooth it out. There we go. And so what you can see is when you're negative, you're usually in like a 2007 to 2008 period. This unfortunately only goes back to 2002. It does show you a negative level in 2002, negative level in 2008 to 9, negative level during COVID, even leading up to COVID, very briefly in 2017 on a quarter negative over here. And then we've really been negative on this job openings course since 2023. And this is why a lot of people are like, oh, we're just normalizing. But the broad question is, what keeps the labor market together right now? Well, right now, the only thing that keeps it together is the lack of layoffs. Because if you end up in a place where you have layoffs in this sort of environment, and then you normalize out to the right, there's no job for you to get anymore. And this is what we're seeing a lot of with the Fed, is the Fed's talking about, hey, it's actually, if you have a job, you're good. But if you've lost your job, that's where things end up getting painful. And so that kind of gives us a little bit of color on Morgan Stanley's talk about 7 rate cuts, the concern the Fed has, like, is this a normalization or are we going to break out, into a disgusting direction? At the same time, the 10-2 yield curve is sitting in shock territory again at 52. So Nothing major new from Powell today. This is more of a reiteration of what we've been expecting. But you do get this talk from Morgan Stanley about 7 rate cuts coming next year. And hopefully it's just because of a normalization of inflation. But if we do get a layoff spike, then we end up with problems. I mean, look at what's going on with Microsoft, for example. You get these thousands of sort of rolling layoffs almost every single month. You know, last month it's the sales division. This month it's Xbox, you know, whatever. What you're also finding is a lot of the big tech companies got a lot of heat in 2022 for conducting these massive sudden layoffs. And now they're preferring this sort of like monthly rolling layoff because it gets less attention than mass layoffs all of a sudden. So that could be another dynamic that sort of slowly breaks the back of the labor market. Not great. Also, looking at what's going on in stocks right now, Tesla bounced very close to our 318 level, which we talked about in the Alpha report heavily over the last few days. Talked about rejecting 347, not wanting to bet on a surge of Tesla, that it was likely to trend towards 318. It's exactly what ended up happening. We also talked about how Circle was very likely to trend back to its 210 retracement line. And given that we're now at 3 days of falling momentum on Circle, we might end up falling right through 210. And sure enough, look at this. We bounce at 210. We bounce at 210. We lose 210. Then we reject 210. I don't know how much more bearish you can get. And sure enough, now we're trending right back down. Next stop looks like it's 182. Make sure you're part of the Alpha report over at meetkevin.com if you haven't signed up yet. Check it out, meetkevin.com. Use coupon code JPOW. Appropriate naming for it, and you get lifetime access. We've got lifetime access open right now. So check it out over at meetkevin.com.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.